Good afternoon, everybody, and welcome back to Schwab Coaching for our next topic, getting started with stock investing. And today we are discussing the what to buy concept in the session. So thank you all for joining me today. You can certainly say hi to my friend and fellow Schwab coach, Cameron May, in the chat. He's going to keep an eye on content there, comments, questions, etc., and work to answer stuff that I'm unable to get to. But of course, I'll try to monitor the chat as well and be happy to answer your questions live and in the moment as best I can. Also let you know when I can't answer those questions if you come up with something I'm unfamiliar with, but I'll certainly do what I can for you. So take a moment, everybody, if you're not already doing so, follow Cameron and me on X. For Cam, it's Cameron May CS, and for me, Kevin Horner CS. Try to post for you there throughout the week. I'm in the habit of bringing up some charts that are catching my eye, giving you some insights as to where stocks reside and what traders on one side might be thinking versus traders on another. So if you're just out there on X and Twitter and you want to make sure you're getting access to all of us coaches, that's a really good way to do it. You can absolutely bring comments and questions to us outside of the classes that we host. So we'd love to have your follow there on X. Now, let's jump into some disclosures, and then we're going to get into the nuts and bolts today for you. So first of all, remember that our discussions here are only informational and educational. We do not make recommendations, and that's going to be particularly important today, and I'll kind of provide a little bit of context for you. But remember that ultimately we're trying to provide you some insights as to how investors and traders might choose to look at the market. What we will not be doing today is, even though we're going to be defining some of these metrics and ratios and things that people will use to understand quality of individual companies, we're not going to be able to define that for each of you individually, of course. What is it you're looking for example, from a PE ratio, from a price to sales ratio, from a dividend yield, for example. We can't define those for you, but we want to give you some understanding as to why traders and investors might rely on them, and then how to utilize those pieces of info to help you to build lists of equities that could be important for you in terms of your own investment process and strategy. So that's what we're going to really work on here today, and in terms of the session. So I'll push us through for an agenda. We're going to define some specific fundamental metrics for us today. We're going to also show how we can utilize these to filter through opportunities in the U.S. market here. It's been a bit of a rough day. And in fact, a day like today, I think, is always the right time to be spending your time defining the list of stocks that you would like to work with. Remember, not every stock is ready to be bought every time you look at it, right? And so one of the things that we commonly discuss as investors is creating, by usage and review of and usage of fundamental data, like some of these criteria we're going to look at today, are really the way to know if you are working with a list of so-called healthy stocks, stocks that are making money, that are returning investment dollars to their investors, either in the form of a stock price appreciation or maybe in the form of a dividend, for example, that might be paid out. So again, we as investors, we need to spend the downtime. A day like today might be a downtime day for some traders, where they're just going to say, man, if I'd had a list of stocks that I was ready to buy when the opportunity hit, boy, would today have been a great day to have that list ready. And so I feel like today's topic can really be a jumping off point for traders and investors alike. How do we find those opportunities when presented? Well, often it starts from a list of stocks that you would like to consider buying, and then just keeping an eye on them in this form of the chart and the price action, so that you know when is that opportunity really present itself, right? You may miss that chance from time to time if we're not paying attention, but the hope is that all that effort we put together in the days and weeks leading up to these individual moves in the market will give us the chance to capitalize when the market moves in the direction that we need it to in order to take advantage of a given opportunity. So let's work our way through some slides here in my deck and talk about some of these key components. So the first one we'll talk about here is price to earnings ratio. PE ratio is fairly standard, fairly basic in terms of what it's designed to provide. And it's a comparison scale that really shows where the stock's price is relative to history, right? We also can utilize price to earnings ratio to review how a security is performing relative to its peer group. So price to earnings, this is calculated by dividing the stock price by the earnings per share amount. And we do that over the last 4 quarters to get an annualized figure, a price to earning ratio. So as an example, the price to earnings ratio compares this stock price relative to their earnings or their profit. The company can create good earnings, of course, but if outstanding shares that have a claim to those earnings, that's you and me and every other shareholder for that stock, then the more of those shares that are outstanding, well, then the less impact that those earnings have on the underlying price, the price action. A company that earns $100,000 annually and has 50,000 outstanding shares, for example, would have an earnings per share of $2, right? $100,000 of revenue, or earnings, I should say, divided by the number of shares. So it really is as simple as knowing what is the earnings per share for the company and how many shares are outstanding, and then just doing that math. And thankfully, here in whether it's Schwab.com or Thinkorswim, either one of these applications, you don't need to do the math. It's just a calculated ratio and figure that we can place in a monitor column. We can also place it as a scan balance, so something we can scan for, right? We can build a request to look through all equities in a given area of the market, and we can incorporate the price to earnings ratio as part of that scan. Now, one of the reminders we have to think about with price to earnings ratio is the lower the price to earnings ratio, the less an investor is paying for a company's overall earnings. Yes, we should always consider alternate metrics, but not just PE ratio. You can always incorporate additional metrics with it. And as usual, what we often suggest is that you incorporate a multitude of details, right? We don't like the idea of always defaulting to one single detail. Think of it like a puzzle piece, right? We want to have a few different data points to aid us in making our decisions. But price to earnings ratio can absolutely be one of those calculations. All right, so after price to earnings ratio, we can, let's see where we move on through. We can talk about price to sales ratio. Okay, so this is the comparison scale that shows where the stock's price is relative to how they are selling their product. So where the PE ratio compares the stock's price to its earnings or profit, and again, a company can absolutely do well in terms of earnings without necessarily seeing significant price appreciation. In price to sales, it's comparing the stock's price to the annual revenues per share instead of earnings. And remember, commonly earnings are going to incorporate a fair bit of data that is net of the gross details, right? Sales is not net. Sales is going to be considered to be essentially gross detail, right? So this will tell if a company is considered cheap or expensive relative to other companies within their industry group. So annual revenues per share can tell investors how much value the market is placing on the underlying equity here. So Again, revenue is the amount of money that a company will bring in from normal business operation, the sales of their goods, of their services, etc. But it is not incorporating the debts at the bottom line, right? So price to sales, we can calculate very similarly. We divide the stock price by the annual sales per share, and we get a ratio. So a price to sales ratio of 1 means that we investors are paying $1 for every $1 of sales. A ratio of 3 to 1 would mean that we are paying as investors $3 for every $1 of sales. If we take it the other direction and the ratio were merely 0.5, well, we are paying 50 cents for every $1 of sales. Now, again, I can't tell us or really speak to, when we think about these ratios, what is the right one, right? Should that number be greater than 1? Should that number be less than 0? The truth is, a good way, I think of it as a proper way to go about this, is just to find the stocks in a space of the market that you're looking in, a space that allows you to look at, say, maybe the 5 top performers, for example, and put them side by side and look at the differences, the discrepancies between these ratios, and see if that aids us in learning a little bit about which is going to be important or maybe more important than others for you as the investor. Now, one of the things we'll talk about is how sometimes even if we want to incorporate price to earnings, price to sales, etc., if we are looking for as many opportunities as we can find, we might find that incorporating ratios like this is going to greatly limit our opportunity for action in the marketplace. And that might be because when you start looking at these criteria, you might find that the technical condition, which is commonly used to locate entry opportunities for stocks you've been waiting to buy, the price action could be right for you, and yet the fundamental criteria might not be. And so, as an example, one of the scans I ran prior to the show was just looking from a technical basis, which stocks in the NASDAQ 100 recently retreated to their 50-day moving average and held. That could be helpful from a technical trading standpoint. But if you're the trader who says, well, that has to incorporate fundamental criteria, and I want to scan the market for my list of stocks, well, then frequently you might find that you're not generating a lot of trade ideas. So bear that in mind. Remember that if you are an investor who wants to rely on data like price to earnings, price to sales, price to book, etc., you might find your opportunity for trade ideas to be far less frequently provided, or you're going to see a list that is much smaller than you might expect. And the reason for that is probably a good one, right? You've defined the important fundamental criteria for stocks in which you want to invest. And not all the time will those be stocks that are familiar to the marketplace or excitable amongst the market. They may not be even stocks that traders on CNBC are talking about every day, right? So that can be very difficult for the disciplined investor who really would like to have more opportunities. You might not find as many when you incorporate fundamental criteria as part of your scan. I'll show you what I mean utilizing a scan tool here after we work through a few more details. Okay, so we just talked price to sales. Let's move on to price to book. So price to book ratio takes the current stock price and divides by the company's latest interim period book value, meaning their last quarter, and basically looking for the true value of the company, which is to say, if the company were to shutter their doors, for example, what would be left behind in terms of overall value? It's looking at the tangible assets like buildings and machinery and so forth, which really underscores that a company in, say, for example, machinery would have a very different look potentially at price to book ratio versus a company that might be tech heavy or a tech company specifically and does everything without physical physical application. Maybe it's all tied to programming and software, for example. That would be a very different calculation for these companies. So, of course, as we lay out here, how do we break this down or how do we calculate it? Well, price to book is calculated with assets minus liabilities divided by shares outstanding. So it's just, what are the total assets of the company? Let's eliminate all liabilities from that. We get a net figure, and then we divide that by the total shares outstanding. And some of you out there might even buy stock as a means of price to book ratio. You might have seen opportunity from this standpoint. I can tell you that in my nearly 28 years of watching the market, there have been instances where a company's price action has taken them to a level below their book value. Some investors look at that as opportunity simply because they believe, well, all of this narrative is so terrible that the price of the stock is below what the book value would be if they shuttered their doors, if they eliminated all liabilities and walked away with money. How much money would that be at a per share basis? If it was $20 and the stock is trading at 12, investors might look at 12 and say, well, that's a really attractive value to be able to buy a stock at 12. And if they shuttered their doors, we might get $20 a share back in the form of book value. Now, that doesn't necessarily work if a company goes bankrupt, of course, but this is one ratio that some investors will look to. So this multiple, investors are likely looking for a lower multiple here because it means that stock value is relatively cheap. So a price to book ratio of 2, for example, would be considered low, while something like 10 would be considered high. And it might mean that investors, what it would mean is that by the math, investors would be paying $10 for every $1 of shareholder equity. Of course, if that number were 2 and you're paying $2 for every $1 of shareholder equity, you can see how that value would stand out as being a lot more favorable as a lower calculation. All right, how about return on equity? Now, return on equity is a profitability measure measuring how efficient the company is at generating profit. So efficiency, that's a win for a lot of investors, right? We want to earn a proper percentage on the dollar that we are choosing to invest. So return on equity we calculate by dividing the company's net income by its equity. Again, this is the net profit of a company that is generated divided by the actual book value of the shareholder capital that a company owes. So this differs from many of the other value ratings that we've covered here because return on equity does not take into consideration the price per share of the stock. Now, when you're thinking about return on equity, commonly investors will look to compare, once again, to the industry group in which an equity resides. And so it is considered good to look at historical numbers to see if the return on equity is something that has been rising over a period of time, 3 years, 5 years, 10 years. It can also be alongside a rise in the company's net income. So if return on equity were growing while revenue is not, it could be a bit of a red flag that the company might be doing something that is aiding them in creating a return on equity that's not coming from a resulting improvement or increase in net income. So that does not mean necessarily that a red flag is something that you want to avoid in this case, because while ROE could be growing and net income is not, it could be tied to the company buying back stock, right? And maybe they're spending money from their balance sheet, buying back stock in the market and increasing their own personal share of the company. That is not necessarily a negative, though. We often see buyback programs leading companies to a price appreciation window of time. So don't take that, as we define it here, as a kind of a red flag because we're not getting net income increase. It doesn't necessarily mean that it's not an opportunity for investors to consider. Okay, let's see. So there's return on equity. All right, now we got to talk about one that is important to small cap companies, maybe more so than your large cap companies. But the reason for that is simply because small cap companies often need debt to do business, right? And so debt to equity can be a measure that some investors will use because high debt companies can be under pressure during periods of rising interest rates like we're looking at right now, which has proven to put pressure on small cap positions, small cap stocks. So very generically, higher debt to equity ratios put the company at risk for continuing to do business. Because in a lot of cases, those debt scenarios, those are provided not with a set rate at which they are charged, but commonly a floating rate tied to something like LIBOR or current yields that we're seeing in the market. So if yields are rising, then a company that took out a big loan to conduct business and they were charged 4% when they took it out, but now yields have jumped and they're paying 5%, well, that is a 25% increase to their costs, right? And that can absolutely play havoc on a company's opportunity to continue to do business. So things can shift quite a bit in the sense of a company that's got a high debt to equity ratio in a rising interest rate environment. So we would consider debt to equity an indicator of financial leverage, comparing the assets that are provided by creditors to the assets provided by shareholders. So we determine this by dividing the long-term debt of the company by the common stockholders' equity, common shareholder equity, that is, which is not to include specialized holders, not preferred stock, etc. So for instance, if we just put some math to this briefly, if we have a company with $100,000 in liabilities, money owed out, and $40,000 of equity, well, they would have a debt to equity ratio of 2.5, indicating that the company has $2.50 of debt for every $1 of equity the company has. So generally speaking, an investor would like that debt to equity ratio to be low. A high debt to equity ratio gives the company a visual of being highly leveraged and thus at risk. However, once more, we know that no single one valuation tells the entirety of the story. But if you were, to look around at the way the market is acting today, as an example, we see, small cap stocks taking it on the chin, moving lower as interest yields are climbing. It stands to reason then, right? It makes sense. Companies who have higher debt to equity from a general standpoint, and granted, you can do all the math, you can dive into the Russell 2000 stocks and find the ones that have the greater debt to equity ratios, the higher debt to equity ratio, which makes them more at risk for difficulties, right? For price depreciation in a rising interest rate environment. But the general aspect is rising yields, bad for companies with high debt to equity. If yields are falling, we could say that the debt to equity ratio becomes less pertinent to the bottom line for an underlying company. If yields are dropping and a company has high debt, chances are that debt at that point is no longer considered problematic because maybe they were getting an improvement from their yield, right? If they took a loan at 4%, yields start falling immediately, and maybe they can refinance, they can even do better. That can add to their bottom line over coming quarters and years. Excuse me. All right, so there we go with debt to equity. Pardon me. Let's bring back my slide here. Next, we have to talk about trade volume. Now, trade volume is a lot different than everything else we've covered here, right? Because trade volume is fairly standardized in the sense that all it's doing is telling us how much activity has a given stock seen at a given day or week or period for that matter. So when we talk about volume, it really is just a question of whether there is a sufficient amount of trade activity on a day-to-day basis to allow an investor or trader to buy shares and, importantly, sell shares, right? So you want to see that there's enough liquidity for you to take that action, to encourage you to buy that stock. And sometimes volume can be that delineating factor. 250,000 shares here on average daily volume is, for many traders, sufficient. Many of you would say either it be 500,000. But think about it like this. If it's 250,000 shares on an average daily volume, how many shares are you trying to acquire? Is it 50,000? 20% of the overall float that we get on a given day? Or is it more like 100 shares, which in the grand scheme of 250,000 shares traded daily, 100 shares is not apt to create a problem for you. So yeah, we just look at volume to ensure liquidity more often than not. If you're a trader by nature, you might look at volume slightly differently. Volume as a trader could be maybe a confirmatory indication of price action to the upside being validated. So, as you see on this particular slide, we've got improving bar, improving bar, improving bar. If these are volume bars and price is going up at the same time that we're seeing an increase to volume, that would be considered by many technical traders or traders by nature would look at that and say, yeah, that more or less confirms that the price action is validated, right? Prices are moving higher and volume is increasing as we do see prices moving higher. Generally speaking, that validates the price action. So very different way of looking at it if you are conceiving of it from a trade standpoint versus just as an investor. Like I say, you just want to be able to know that whatever it is you're purchasing, you should be able to sell it as well. Okay, now after trade volume, let's start looking at some types of examples. See if this can help us out a little bit. First of all, I wanted to bring up Thinkorswim, and I mentioned looking at something like the Russell 2000, and really I just want to give you all some concept of correlation, I guess. Let's just look at what's gone on here with the small cap index since we've peaked. We peaked in November. This was November 25 at 2466, and we've undergone a pretty decent pullback. But more importantly, we have this level that we've rallied into. Now, it could be that static level, this red line, but it could also be this dynamic purple 50-day simple moving average. What is that? That's very basic, just the average closing price of the last 50 trading sessions. Now, what's interesting to a lot of traders about this is that we have this peak and we've been going down essentially since that peak. If we looked at how yields have acted since November 25th, we're going to look at that right here with the 10-year yield. And let's just go back to November 25. All right, so here was the peak in the Russell 2000. Okay, notice the yields went lower first for about another week and a half, almost 2 weeks. But then we got this big move in yield. Yields rallied from a level of just about 4.125 all the way up to that high you see, 48.09. In terms of what that reflects from a 10-year note yield, We just move that decimal one place to the left. That's 4.8% essentially. Now, the reason I'm showing that is that the Russell peaked here and has not been higher since, right? Yields peaked here on January 14. Well, let's go back to the Russell. When the yields peaked on January 14 and started retreating, oh, look at that. January 13 and then the subsequent 14th was the day that the Russell got its bounce. So there's clearly some semblance of a relationship here between yields moving and the impact on small cap stocks. Why? Small cap companies, what do we know about them? They tend to have that larger debt to equity ratio, right? So that makes this small cap group a yield sensitive group. And if yields were to retreat at a greater amount, or maybe we took out a level that we haven't previously noted. So like say, for example, we took out this white line, which was where we bounced most recently. That would change the subsequent trajectory likely of 10-year yields, and that might give lift to small caps thereafter, everybody. So I hope that makes some sense. I wanted to provide, just a conversation, taking the conversation around debt to equity and how that can be impacted when looking at small caps specifically. I feel like this does a pretty decent job of exploring that relationship between the two and why one scenario, one calculation, debt to equity, could be so important for specific traders. In this case, traders of small cap stocks, right? Okay, earlier in this discussion, I mentioned that we can incorporate some fundamental criteria with our scans in an effort to locate opportunities that fit what we're looking for, right? So what we can start with is building some lists. I wanted to just give you a couple examples. I'm going to come to the scan tool, and I'm going to tell it to reset everything. So by default, I've just got 3 stock-specific details here, okay? Not a lot, but we're just going to look for a stock. Let's do average volume. So I'm going to eliminate a couple of these, and we are going to add in, remember I mentioned volume being an important aspect. We want to make sure that volume is sufficient. So we're going to add a volume component with add filter and study. Now, when you add a study, everyone, the default study is ADX crossover because it's listed alphabetically. It's right at the top, okay? But what we're going to do is click that pencil, and that brings us this window right here. And I will just delete ADX crossover and select to add a condition of my choosing. So now I'm going to use my drop-down menu, and we're going to go to Study, and we are going to look for volume. Let's do it this way. All right, so we have quite a few volume opportunities here. There's volume average, okay? So I'm just going to designate that I want the average volume of the last 50 trading days. Notice here, I might have to designate this plot as volume average. This is what I'm specifically looking for. The average volume of the last 50 calendar days is greater than, not 50 calendar days, the last 50 trading sessions, is greater than, and then I'm going to designate that value, okay? So 250,000. And so all that's doing is saying, based within one bar, that's saying I'm looking at this on a daily chart. Is the average volume greater than 250,000 shares over the last 50 calendar days? 50 trading sessions. Again, I'm making that mistake. So I'm just adding in volume as a key metric. Okay. Now I'll hit OK. And I've got that right here. There's my volume average. Now let's add in some fundamental criteria. Add filter, fundamental. Now there's my fundamental. Here's your drop down for your alternative options. So let's say that we want to look, we were talking debt to equity. Let's check out, let's see, is debt to equity? Of course, debt to equity wouldn't be one of my options. Why would it? That'd be too easy, Kev. Let's go ahead and go with price to earnings. And let's say we want a PE ratio that's at least 10, but doesn't exceed 25. Now, that might be a little high for some, might be a little low for others, but you can see that within the overall market, there are 2,000 plus companies with the PE ratio between 10 and 25. Now, that's a very generic list. And again, I can't give specifics on playing with these criteria, but I'll mention this is where we as investors and traders have the opportunity to really create lists that are going to be workable for us. And that means playing with this criteria, rescanning, generating the list, and really getting it fine, creating a finer list than you may start with. A lot of the time, that just requires us to play with the criteria and get things to line up the way we're hoping for. So let's also incorporate a price per share. So why don't we just go back up to closing price? So just last trade essentially is the close. So we'll say at least 10. Some of you might want to put a cap on this. You may want to, you may not, but at least this way you're not going to find stocks under $10 a share. For our purposes, let's make this $100, and that'll greatly reduce our number here. Well, not as great as I was hoping for, evidently. So 5,500. Now, so what are we looking at? Stocks between 10 and 100 a share, with a PE between 10 and 25 a share, with adequate volume from our conversation here, average of 250,000 for the last 50 trading sessions. Now, let's change this. Instead of scanning in all stocks, let's say we want to look in the S&P 500 exclusively, and let's just see how this looks. Okay, that's a pretty healthy number. 98 companies who are fitting this criteria. We're only seeing 50. I'd have to change to 200 to see them all. And then my list is all 98. There they are. Okay. Now that's a lot of work for many of us, right? So this list, as is currently constituted, is generic as heck, right? Trade price, 10 to 100, PE ratio between 10 and 25, and average adequate volume, right? 250,000 a day. Not a big deal. If this list were the list of your what to buy, right? The list of stocks you want to know, that you want to be a buyer of, and now you want to apply maybe some semblance of technical conditions, well, then we could whittle this list down to a different level. So one of the things we can do, let's just save this as a watch list. I'm going to title this something, again, fairly generic, because I try to keep it as basic as possible here with us in these classes. No need to get cute. So let's just call this let's do SPX PE ratio. Okay, so SPX and PEs. I'm going to hit save on this. All right, so that watch list is available to me in my personals. So I went into right here, and SPX PE ratio. Oh, actually, the one I just did right there is SPX PE. So the SPX PE is a watch list of 98 companies now, right? Now, if I'm the trader who says, boy, I would love it if I had some technical condition that was making it wonderful for me to own that any one of those 98 stocks in my list. Well, let's go to create scan, or to load a scan rather. And I've got a, let's see here. We've got some public scans in here. I've got some personal scans. Let's use a personal one of mine. Let's look at stocks that are considered in an uptrend, but are oversold and might be testing their 50-day simple moving average. Okay. So this is where I think this will kind of outline what I was talking about. This is a scan that is going to show average volume of stocks over 500,000. Stock is in an uptrend because their 10-day is over their 50-day simple moving average. The 50-day simple moving average is greater than the 100-day. And the last trade is above the 50-day simple moving average as well. Okay, so what we could be seeing here are stocks that are in an uptrend but may have retreated to an area of support. In this case, the 50-day moving average, and holding it. So check this out. The only one stock popped on this, so I'm gonna click it. Okay, now I can see why that one popped up for us. Here we are in an uptrend, right? Lower left to upper right, and our last trade is above the 50-day moving average, and the short-term moving averages, I don't have it on here. Let me change that to incorporate a 10-day. There's a 10-day. The 10-day is above the 50-day. Let's put that back on. Here's the 50 and the 10 days up here. So we know the 10 days above the 50. That tells us we are in a short-term uptrend as well. And we are now above that 50-day simple moving average. But what I want you to recognize, everybody, is that this is nothing but technical criteria, right? So if I wanted to scan that whole list that I created, instead of scanning in the S&P 500, just come to your personal watch list and scan within SPXPE. All right, and all of this criteria holds, but now you're scanning the list that you created that fit your fundamental criteria. In this case, that price to earnings ratio we were hoping for. Now, unfortunately, when I hit scan, I do not expect a single stock to appear here because we only found one in the S&P that was matching this criteria perfectly. Okay, so this is where I get back to what I jumped off the conversation with. If we are using fundamental criteria and incorporating technicals as well, there's a good chance we may not have an opportunity any given day of the week. Okay, so this is once again where we as investors and traders really need to spend our time creating and customizing the watch lists, customizing and creating scans, and working with the scan criteria to aid us in getting what it is we want from. I hope that's helpful for you all, everybody. I want to point out, yes, today, we have about 5 or 6 different classes specific to getting started with stock investing, and today was more tied to the what companies I want to own, why. So recognize that you can absolutely fall back on the YouTube page, and you can use playlists right here. You can even search. If you wanted to just do getting started with stocks, you're going to find my playlist right here. So go to playlist, and now you've got this in addition. And it's not just me hosting it. Connie and Barb and Brent, we've all hosted this one. As you can see, you can absolutely go back in time and watch any number of these as much as you'd like, pause them and rewrite them or review them again. It is incumbent on us to keep doing the work. The learning never ends, everybody. I hope you guys recognize that. So I want to thank you all for joining me today. I know that it's been kind of a quiet in terms of the chat, but I hope that our conversation kind of opened your eyes to some of the ways that we as investors can use the tools at our fingertips to build lists that can be very helpful on a red day like today. I know it didn't play out that way with the fundamental criteria that we hit, but I want to just give you the idea that open our minds up a little bit and recognize that we have these tools at our fingertips and we just need to play with them a little bit more. So with that, as always, big thanks to Cam in chat here today. Big thanks to all of you for sticking with me and staying in the class. More to come from us tomorrow, of course. We got one more session here for today. Following this, I'll go back to where we were. Let's see. I've got it right here. Who we got coming up, everybody? As soon as this page loads, it is Barb with using options to generate income. So if you all are looking forward, oh, excuse me, after the close, my apologies, everybody. There you go. Barb, waiting for you. So if you're looking for a way to finish out your day, that's the one. If not, I'll be back with you all tomorrow. Reminder, Trader Talk at Market Open, 9:30 a.m. Eastern. Tomorrow is our lone non-archived Trader Talk, so got to be there live for that one. Again, 9:30 a.m. Eastern with Market Open. But hope you all have a fantastic rest of your Thursday, everybody. Thanks for joining me today. I look forward to seeing you all again real soon.